Alright, so in the last video, we talked about how to buy and short sell individual stocks using the MarketWatch platform. And I was showing my portfolio to you guys, and I show that GoPro, G-P-R-O, this ticker symbol stands for GoPro. That's an individual stock that I shorted. But then I also mentioned this one, VSGAX, that it's an index fund. But I put it off. I said we'll talk about that later. Well, now we're going to talk about that. What is an index fund? It's really just a basket of stocks. So I'm going to show you how I found this stock. First thing I did was I did a search for mutual fund or fund companies, and I came across this term called asset management companies. Well, asset management companies are just companies that package investment products for us to buy, and then they charge us a small fee. So what we care is what are those fees they're charging us, and so I like to shop around. So I shopped around. I went to all the websites here for BlackRock. This is the largest. They have 5.6 trillion in assets that they manage. Vanguard Group 4.7 trillion. So these are the big ones. Here's JP Morgan. We're going to talk about them in just a minute. So Vanguard. And so when I was shopping, I looked at all these websites and I was looking at their funds, and I was comparing the prices, the expense ratio. What do they charge as a maintenance fee for purchasing these products? And so I ended up with really liking Vanguard Group because their fees tended to be the lowest of all of these guys on average. Now once in a while I'd run into one or two funds that they're a little bit higher than some of the others, but most of them, just about all of their funds, are priced lower or equal to the lowest of all the other guys. So I'm going to talk about the Vanguard. You're welcome to search any of these big ones. So we're going to go to Vanguard real quick, and I want to show you, well, first I just want to refresh VSGAX. That's the name of a fund that we're going to be looking for. So we go to Vanguard's website. I clicked on the investing. I went here to investment products, and then there was an option over here that said stock funds, and so this brought me to this page. So Vanguard funds, stock funds. Well, I scroll down. I've got large cap. We've got, and by the way, these are each funds, groups of stocks that they offer for us to purchase. And what do they charge us for them? That's what this expense ratio is. They're charging us a 0.04% fee every year that's taken out of your holdings to pay for them managing that fund for you. So VFIAX, this really doesn't mean anything to you until I actually get in and look at one of these funds. So I'm scrolling down and I'm looking for the fund that I have on the MarketWatch game. VSGAX, there it is. It's called Small Cap Growth Index. What's the fee? 0.07. So I'm going to click on this guy. Brings me a page, a summary page of this, and it has multiple pages with information. I'm going to click on the portfolio because I want to show you what companies are held in this fund. So what did Vanguard go by? Let's see here. Right here, Diamondback Energy, XPO Logistics, all of these companies Vanguard purchased in this fund. So for example, I'm going to click on portfolio holdings so it shows us the entire list. And we'll see that Vanguard owns millions of dollars of each of these companies. For example, here we are, 642 different companies that this index fund purchased for me. So I don't have to go shop and buy a little bit of each of these. It does it for me. And that's why I pay that 0.07% expense ratio fee. Happy to pay it because they're diversifying for me. So here we are. They own $164 million worth of Diamondback Energy. They own $145 million worth of XPO Logistics, and so forth. You can go down the list and you can look at all 642 companies and see how much they own. And so that's the whole point of an index fund, is that you're diversifying, you're decreasing your risk. And what I mean by that is, like, let's say 1 or 2 or even 5 of these companies, of these 600 companies, go bankrupt in the next year. You're happy with that. You're fine with that because the other 600 and some companies are doing just fine, or they're picking up the slack. Maybe they picked up those customers that the other ones lost when they went bankrupt. And so the point is, on average, the average of all of these 642 companies, it's going to keep growing. They're going to keep going up. And so you're diversifying, you're decreasing your risk. You're not putting all of your eggs in one basket. Now, that's the point of buying buying index funds. Now we have the small cap, mid cap, large cap, what you saw on that last page. Small cap meaning these are the smaller companies. Now, not necessarily mom and pop companies. These are actually pretty big companies by our standards. We're talking, they could have 500 employees and they're still classified as a small company. So they're not small by what we would consider small. So anyway, I just wanted to show you the fees and show you what a fund is. And now I want to compare fees. If I go to, let's see, we were looking at these companies. JP Morgan I mentioned. I looked up one of their stocks. Let's see, is this it? No. Let's go see. Here it is. JP Morgan Growth Advantage Fund. Here we go. It's ticker symbol VHIAX. What's its expense ratio? Ooh, 1.25%. That's not good, especially not compared to the Vanguard fund. So let's do a little, in Excel here, we're going to do a little cost comparison. If I invested $1,000 in the Vanguard fund, and they're charging me 0.07%, remember I have to add 2 zeros before the decimal if I convert it to a decimal, that means that they're taking out 70 cents for every $1,000 that I invest as a management fee every year. Well, look at the JP Morgan, it was 0.0125. They're taking out $12.50. You see the difference? It's quite significant. In fact, over 30 years, that can be, depending on how much you invest. If you put in $1,000 each year and you're growing this fund, we're talking thousands and thousands of dollars. Over a 30-year period, that could be the price of a new car. It's very significant over time. And that's why I shop around and I look for the low expense ratios. And that's why I ended up at Vanguard's website, because they overall, on average, they have the lowest fees. And so I really like investing with them. Now, let's look at one more thing here. One more thing, and that is the beauty of competition. So Fidelity, I wanted to take note of something they did, because Vanguard was growing significantly. In the last 10 years, they've grown quite a bit, taking a lot of the market share away from a lot of these other guys who charge more. So, the beauty of the free market, I went to Fidelity's website and look at what they're doing. About a year and a half ago, they said, hey, we want some of those customers back that Vanguard's stealing from us. So, they packaged some of their index funds. They priced their fee expense ratio at 0.035. And look at this one compared to this fund, which buys pretty much the same stocks, the same companies behind the scenes. This one buys pretty much the same companies as this one. So here you have Vanguard on this side, Fidelity, and look what Fidelity did. They lowered their fee by 0.005%, 5/1000% lower, just to say, look, we beat Vanguard's fees. Isn't that the beauty of the free market and a free market system? Competition always serves us customers better, always. So, I just wanted to point that out, that now Fidelity is trying to beat Vanguard, and they can advertise and say, now 28 out of 29 of our funds beat Vanguard. Now, there's one more thing I want to cover before I stop this video, and that's ETFs. I want to point out that ETFs are very, very similar to funds, mutual funds or index funds. That stands for exchange-traded funds. Exchange-traded funds, the difference really is that they can be day traded. Throughout the day they can be bought and sold, whereas in the funds they have to follow a different set of rules and they can only be purchased at the end of the day, pretty much like right when the market is shutting down, then they trade. And so you don't day trade those. They're for buy and hold for long term. ETFs can be day traded, but they're also a fantastic tool for bundling with low cost. So I clicked on Vanguard's website. I went to the ETFs instead of mutual funds, and I want to show you. So we have bond ETFs, we have stocks. Here's what we're getting at, and this is what you guys want to invest your money. When you're young, you want to invest in stocks. And so the stock ETFs, let's go down and let's find one that's comparable to the other index fund that I was looking at here. Oops, sorry, I had to stop that. Here's the small cap growth ETF. VBK is the ticker symbol. Let's go look at this. And let's see what companies this fund is holding. VBK. We're on a bit of a lag here. Alright, so I'm going to click on the portfolio and management tab and see what companies it'll. Oh, look at that, the same companies, Diamondback Energy, XPO Logistics. Look at that, the first ones are exactly the same. And I can click on the portfolio holdings again and see that they own $164 million worth of Diamondback Energy. And so what I'm trying to point out here is that as a young investor, the ETFs are just as advantageous as the index funds, pretty much the same thing. What you care about are the fees. You care about going through the chart, looking at the fees, expense ratios. And so that's it. I just wanted to make sure that you have an understanding of what an ETF fund or an index fund is and how to shop around and look, and how do you shop around for low fees. Just go company to company and start looking through the funds. And what you're looking for is the term expense ratio. They have to, by law, disclose the expense ratio. And that's what you're going to be looking at, looking for low expense ratios for the different funds that you want to purchase. Happy investing.